This week on Wealth Track, an intellectual superman assesses the impact of U.S. debt on the nation's economy and its historic role as the #1 power in the world. Harvard and Oxford's financial historian Niall Ferguson tackles the U.S. debt dilemma next on Consuelo Mac Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Did you know you can take Wealth Track with you? You can watch full episodes, you can watch the highlights, or read the newsletters, whenever, wherever. Let me show you how. In your web browser, type in m.wealthtrack.com. That's it. So join Wealth Track whenever and wherever you can. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mac. Earlier this year, we were privileged to sit down with financial thought leader, British historian Niall Ferguson. In March, we broadcast part of the long conversation we had and focused on the seismic shift of economic power from West to East. Ferguson's new book, Civilization, the West and the Rest, which will be released later this year, analyzes the 500-year evolution of the West's economic, political, cultural, and military dominance, why it happened, and why it is now changing as developing countries led by China are surging ahead to become global economic powers. Ferguson is a huge admirer of the U.S. He is worried about its future. Our interview began with his assessment of the U.S. economy and the threat to its health posed by several issues, including burgeoning government debt. This summer, as sovereign debt concerns in Europe cast a dark cloud over global financial markets, Professor Ferguson's remarks about the burden of U.S. debt take on particular relevance. According to the independent research firm ISI Group, by next year, the U.S. federal debt could be equal to the nation's entire economic output, or GDP. As this chart shows, just a little more than 30 years ago, debt to GDP was just over 30%. That puts the U.S. in the sorry company of the European nations that so concern global investors: Greece, Italy, Ireland, and Portugal. Niall Ferguson is one of those rare individuals who has the intellectual firepower to tackle broad sweeps of history. The titles of some of his books underscore his wide scope as an historian. Colossus, The Rise and Fall of the American Empire. The War of the World, 20th Century Conflict and the Descent of the West. The Ascent of Money, A Financial History of the World. A professor of history at Harvard and also at Harvard Business School, senior research fellow at Oxford, author of numerous articles, columnist for the Financial Times and Newsweek, Ferguson is also a television personality. He hosted a PBS documentary series based on the ascent of money and has a forthcoming TV series based on his latest book, Civilization. I began the interview by asking Ferguson about the state of the U.S. economy, post-financial crisis, and after the waves of unprecedented government stimulus.
I think we're in that state where we've got ourselves out of the near Great Depression. I mean, things were really bad, 08, 09, and I think up until the summer of 2009, there wasn't much to distinguish our situation from that of the early 1930s. It looked like being the Great Depression, and it was scary. From the summer of 2009, we avoided that scenario, which is why I said it was a slight depression, because it was a depression, but just not a great one. But the trouble is, the reason that we didn't have a Great Depression was that we threw massive fiscal and monetary stimulus at the problem. And I think that was the right thing to do. A Great Depression would have clearly been worse. But that stimulus has left us with a hangover. And the hangover takes the form of an enormous overhang of public debt. The debt to GDP ratio has doubled in less than a decade, mostly as a result of what we did in response to the crisis. And there's also been an enormous expansion of the Federal Reserve's balance sheet, which is the monetary base of the entire monetary system.
To over $1 trillion.
Right. And so you suddenly find yourself nursing a hangover, asking yourself, how do we stabilize this explosion of public debt? I mean, at the moment, the federal government is on track to borrow another $1.something trillion. For the third year running, there will be a deficit of around 10% of gross domestic product, which in the past we'd have associated with a major war, even a world war. And we also have this question, what is the Federal Reserve going to do if quantitative easing Mark II doesn't deliver the promised results? Are we going to see the Fed buying more and more bonds, QE3, QE4? And what is that going to do in terms of inflation? So I would say we can put the depression behind us, but now we're dealing with this strange and almost unprecedented hangover because we've never really been in this situation before. And the risks are really significant.
So why are they so significant?
In terms of gross domestic product, the share of the federal debt in public hands as a percentage of GDP is on track to be close to 80% and maybe even as high as 100% in less than 10 years if Congress continues to behave as it has in the recent past. Let me give you an example. Just before Christmas, 2010, the Congressional Budget Office came out and said, if we are to stabilize the debt-GDP ratio, to stabilize it, just to stop it growing, then either we have to increase all federal taxes by 11% or cut all federal entitlements by more than 12%. Practically the next day, Congress and the White House agreed on another $900 billion of borrowing over 2 years. So there's a huge disconnect between what has to be done. And this isn't just from the Congressional Budget Office. The International Monetary Fund says the same. So does the Organization for Economic Cooperation and Development. I mean, there's a complete array of advice to the US government to do something to stabilize the burgeoning debt. And the politicians continue to do exactly the opposite and continue to run these huge deficits. Now, I think there's a risk there, which is extremely important to understand, because we've seen already in Europe what can happen.
We've seen in Europe what can happen, but of course Europe now is cutting spending, correct? With not really withdrawing the easing yet. So why is that so alarming? What is happening in Europe to the U.S.?
Yeah. So what happened in some European countries? Greece, Ireland, to some extent Portugal, possibly Spain, was that the financial markets, the bond market, lost faith in the policies of governments. They started to say to one another in the trading floors, these guys have borrowed too much. And that can't end well because they currently have deficits of up to 10% of GDP, even higher in the case of Ireland. They have debt burdens that are either close to or above 100% of GDP. And it looks incredible that they will be able to manage this without some kind of default on their obligations, because they certainly can't inflate away the debt, because they're part of a monetary union with the Germans. So that was the scenario that kicked off the sovereign debt crisis in Europe. What happens in a sovereign debt crisis is that you lose credibility. And whereas yesterday you were able to borrow at 3.5% for 10 years, or maybe 4%, tomorrow you suddenly have to pay 7%. So you have a massive run-up in the borrowing costs. And that creates a kind of death spiral, because with every 100 basis points more of your interest rates, your borrowing costs go up, and therefore you have to borrow more to pay more interest, and down you go. That's essentially what happened to Greece.
But Neil, is that a fair comparison? I mean, we're talking about Greece and Ireland versus the United States. I mean, they're almost like on two different planets. Are we really in that much danger of our worldwide credibility, the inability of or the unwillingness of people to buy our debt? Are we even close to that?
Well, obviously, Greece and Ireland are small economies, and they're in the EU. No monetary sovereignty because they're part of a monetary union. So there are clear differences. On the other hand, when you look at, for example, the ratio of public debt to tax revenue, the federal government's position is actually worse than that of any of the so-called pigs, worse than Greece. And that's very interesting, because it means that the United States, although it's much bigger than these small European countries, and although it has monetary sovereignty, it is still on the same planet, and it is still bound by the same economic rules that say at some point there's a ceiling. And we don't know where that ceiling is, but there is a point at which the government is clearly borrowing too much, clearly owes too much, and at that point investors are going to ask for some kind of compensation for the risk. The risk in the case of the United States is not so much default, although there are some states, for example, California or Illinois, which may well default. But the risk from the federal government is that it will inflate, that the Fed's so-called quantitative easing is just a euphemism for printing money, and the more bonds it buys, the more money it issues, and ultimately the bigger the risk of inflation. Already, investors are asking for a higher premium, a risk premium against future inflation than was the case before QE2 was even announced.
Right.
So here's the key. The United States could suddenly find itself facing a significantly higher risk premium and therefore higher nominal rates if investors decide that we're headed for higher inflation, or even just that we're headed for higher growth. I mean, the policy could work, in inverted commas, and the result could be higher yields. Now, that sounds all a bit technical and nerdy, but what it translates into in the short run is, for example, higher mortgage rates. So the housing market, which we've already said is frail, takes another hit. And I think this is the end game in many ways. Of these two enormous stimulus packages, one fiscal and one monetary, that got us out of the Great Depression. Now there's a real problem. What do? Do you start doing what the United Kingdom has done? Do you start really attacking public spending, really cutting by as much as 30% in the case of some departments, public expenditure, and also increasing some taxes to try to narrow that gap? Everyone agrees that the United States has got to close this huge structural deficit, which has got nothing to do with the recession. It's got everything to do with the fact that the federal government spends more than it raises in taxation. And we're talking by as much as 8% of GDP. Now,
so those solutions are not in our political zeitgeist right now, as you said, completely the opposite.
It's inconceivable that a politician could stand up and say, I propose to cut all entitlements by 10 or 11 or 12%, and I propose to raise taxes by comparable amounts. That's just political suicide. So here's the situation we have. Everyone agrees the United States has a fiscal problem, except the politicians who have to do something about it, which means, and you can see it in the numbers that the Congressional Budget Office just published, that the US will continue to borrow $1 trillion or thereabouts year after year after year after year. And the debt will therefore keep growing until it's about 100% of GDP within a decade. That seems like a very likely scenario, absent a major change in the political culture. At some point, the markets are going to call time on this process. That seems clear.
And certainly the Tea Party movement is part of that, whether or not it actually ends up, taking the kind of steps that you're talking about. But again, one of the things that you have mentioned to me earlier is that you think that the traditional methods of dealing with budget deficits, which you just described, which is raising taxes, cutting the budget, is not going to be sufficient in the case of the United States because our problems are so large. So what is the solution? If those two traditional methods are not going to work, what is going to work?
Well, I think one of the important points to realize is that if you just try and make these fiscal adjustments through the normal budgetary process by raising taxes or cutting spending, you can end up in a kind of self-defeating cleft stick, because the action that you take in the name of austerity causes the economy to contract and makes the fiscal numbers worse. I mean, there's a risk that that could happen even in Britain. It's certainly already happening in Ireland and in Greece. So if the United States goes down the austerity route, then I think it will be very painful. Is there an alternative other than for the inflation genie to be let out of the bottle? I think there is actually. What's interesting is that it's hardly being discussed. The alternative is to think of the United States, or indeed California or Illinois, rather as one might think of an excessively leveraged company. What do you do when the balance sheet looks this way, that there's too much debt? Well, how about selling some assets? Now, what's interesting is that when you look at the United States, considering we're supposed to love the free market here and be suspicious of big government, this is a country where there's hardly any serious discussion about privatization. Other countries, including even China, have done much more, for example, to privatize their infrastructure, their transport infrastructure. And the United States could easily do this.
Indiana did it, for
Indiana
instance,
has done it.
Their
Chicago has one bridge. And that's it. There are a few public-private partnerships, but essentially the entire network of highways, state and interstate, are in public hands. There is a huge proportion of land in the west of this country which is owned by the federal government, which for some reason never got sold off to settlers in the days of the great western frontier. Not to mention considerable numbers of office buildings. And we're not talking here about Yellowstone and Yosemite. We're not talking here about the Capitol and the White House. There are substantial assets on the balance sheets of the states and the federal government that really ought to be getting sold.
To whom? Who's already buying? China?
Let me tell you my little story from The Good, the Bad and the Ugly, my all-time favourite Western. There's that great scene in The Good, the Bad and the Ugly when Clint Eastwood and Eli Wallach think they found the gold. They know it's in a grave and they've found the cemetery. It's just that the cemetery is a huge Civil War cemetery with thousands of identical graves. And Clint Eastwood, Blondie, looks at his gun and he turns to Tuco, Eli Wallach, and he says, "There are two kinds of people in this world, my friend. There are those with loaded guns and those who dig." That's the world economy today. There are those with loaded guns, by which I mean sovereign wealth funds, countries with large surpluses
China,
and international
Russia,
reserves, China,
Norway.
Norway, Singapore, and the list's actually quite long, some of the Gulf states, and there are those who dig. In other words, there are those countries that have got themselves into a real debt crisis, hole. And actually, the simplest way to get out of that hole is not to dig in terms of taxing and cutting spending. The simplest way is to find the treasure and give it to Blondie. And that is really the solution to the problem. We need to see significant sales of assets, like highways, to sovereign wealth funds, including those in Asia. And I can almost see it in your face, Consuela, the kind of consternation that this idea arouses in Americans. What? America sell its treasures to the wealthy Asians? Well, the answer is yeah. Got any better ideas? If the alternative is higher taxes or goodbye Social Security or higher inflation, I think this seems like a pretty rational way to go. And frankly, I think if America's infrastructure, which, by the way, compared with the infrastructure I see in China, is really degrade, if it doesn't get significant investment, this country has a problem. The investment is not going to come from government, because government is more or less bankrupt. The most likely place that we're going to get the money to overhaul this country's transport system is, in fact, Asian sovereign wealth funds. So I would say bring it on. We need a new age of privatization. What I find baffling is that nobody in this country where the free market is supposed to be loved with almost religious zeal, nobody's talking about this.
Well, now you are, Niall Ferguson. No question.
I want to start a debate on
Track,
this.
we're going to start this campaign.
A debate.
So, Neil, solutions then. I mean, what is it that the U.S. can do and the West can do? I don't know. Is Europe a hopeless case? I mean, seriously.
Well, it's much harder for Europe to sort itself out. The problems are deeper and the institutions are more dysfunctional. For the United States, I think the solutions are pretty clear. One we've already talked about. The United States has to set its fiscal house in order rather than just waiting for a financial crisis, a bond market crisis, to do it, as it were, from outside. That's the worst way of addressing your fiscal problem, because it's much, much harder once there's a panic. So I think some reform of public finance with a 10-year time horizon to really get back into equilibrium, with asset sales as one of the key steps that we really need to take much more seriously. I mean, privatization needs to be number one on the agenda for a serious discussion about fiscal reform.
Which would make government smaller.
We need to make government smaller. There's no particular reason why government should be good at running infrastructure. In fact, at this point, it's positively bad at it because it can't invest. And if you can't invest in roads, guess what? They get potholes. So that's part one. I think part two has to do with education. Now, people talk a lot about educational reform, but I'm not sure that they really get what has to happen. Part of the debate, understandably, is about teachers, but I don't really think that is the key. I think the key is the content and the mode of delivery of the stuff that gets taught in schools. And whether you just take history, I think the way history is taught in Western schools, both sides of the Atlantic, is really terrible. The textbooks are stodgy and dull. The kids leave school knowing pathetically little. They're not engaged in the way that they should be in understanding the great story, which I've been talking about, the rise of the West, what it was all about. It's really astonishing how little people leave high school knowing, and that's as much history as they generally do. So I want to see a new generation of e-textbooks in schools, electronic textbooks that are really engaging, that electrify the school children in the way that the most exciting computer software can. And I want to see us telling much more persuasive stories about the way the historical process has unfolded. It's just to give you a simple example, it's impossible, I think, to understand the rise of the United States separately as a story on its own of American exceptionalism. You have to understand it as part of the extraordinary explosion of dynamism from Western Europe, not just across the Atlantic, but all around the world. So I would like to see a revolution in the content and the mechanism of delivery of education in our schools. I think it can apply to every subject. We've got to make school exciting. I'm sure that would be as big, if not a bigger contribution, than a radical transformation of the teaching profession.
That sounds like a radical proposal, number one, and one that is very unlikely to happen.
Well, what are the obstacles to
Yeah.
it? Why is it that the most dynamic and impressive students, increasingly that one sees at American universities, are not US citizens? Because we have a problem in our high schools.
Right.
If we're serious about the future of this country, that is where we have to start. It's too late. You can't address it at the university level because the problems are already well established long before people
elementary
apply to
school.
college.
Right.
So we really need to get serious about that issue. And I can't think of any more important thing than to improve the quality of public education. And it's not just for the United States. This is a problem for Europe too. And it's right across the spectrum of subjects. If we want to have a successful 21st century and retain even some of the preeminence that we associate with the West, that's what we've got to do.
From an investment point of view, I mean, these are obviously, these changes that you're talking about, both political and economic, are incredibly significant. So let's just deal with the here and now, the reality that we are faced with. So from an investment point of view, what do we do? How do we invest? Do we invest in the growth of the rest? I mean, is that basically our best way to at least to get some momentum going in our portfolios?
Beware. There's been a great run for emerging markets right through this financial crisis.
There has been.
You did a lot better if you'd bought Brazil in early 2007, or really almost any South American economy. You did a lot better than if you sat tight in the United States or in Europe. But there's a danger there. There's an old joke which I'm fond of, which is that they're called emerging markets because they're where emergencies happen. And we've just seen right across North Africa and the Middle East what emergencies are like.
Right.
And these emergencies commonly happen when, for example, food prices double. One of the unintended consequences, not only of the emerging markets boom, but also of massive monetary stimulus by the Fed, has been a huge increase in commodity prices right across the board. Hardly any commodities have not gone up in price by significant amounts since early 2009. Thinking back to our earlier conversation about education, I'd rather invest in companies that have really bright solutions to this education problem. Right now, the textbook is a dying form. The future belongs to whoever comes up with let me put it this way, the educational equivalent of Facebook. Facebook's not about education, it's about dating. That's really the point. But what we need is a software solution to the problem of educating our kids, so that instead of just chatting inanely to one another on Facebook, they learn stuff. The company that comes up with something that is as compelling as Facebook, but actually delivers educational content, that's the company I want to own.
Is there any company that you know that is doing that?
Not yet.
That's even close?
Not yet. There are some people out there. Yeah, of course. Well, I could, at the risk of, talking my own book, I could certainly make a suggestion. But I would rather, at this point, just make the proposal. Right. We need much more of that kind of innovation, that kind of company, than we're currently seeing. I think the notion that the world is going to be saved by social networking is a little naive, frankly. I think the world is going to be saved by good education. It is good education that will produce the kind of people that come up with meaningful solutions to the problems of the 21st century. And we need to invest in companies that are actually going to produce that.
Niall Ferguson, with your new book, Civilization, The West and the Rest, I look forward to reading it.
Thanks very much.
We are looking forward to reading Niall's book when it comes out later this year. In the meantime, we would like to recommend a couple of other books for you to take on your summer vacation. The first one is a former pick of ours and a choice of Niall Ferguson's as well. He wrote a highly favorable review of it in the Financial Times, in which he recommended it to Fed Chairman Bernanke and his counterparts in Europe and China. It is Lords of Finance by Liaquat Ahmed, the winner of the 2009 Financial Times Book of the Year Award. It is about the mistakes central bankers made which led to the Great Depression. Given the challenges facing central bankers today, you can understand why it is so relevant. A second summer read is The Wizard of Lies, the story of Bernie Madoff's $65 billion Ponzi scheme by New York Times reporter Diana Enriquez. This meticulously reported book tells the inside story of how Madoff pulled off the biggest Ponzi scheme in history and its consequences for thousands of his victims. Next week is Pledge Week for public television stations, so WealthTrack may not be available on your public television affiliate. However, if it is, you will have the pleasure of seeing great investor Mark Headley again. The chairman of Matthews Asia Funds and a pioneer in Asian investing will discuss the lessons he has learned about investing in Asia, and he will share some advice for individuals about international diversification in general. In the meantime, please go to our website, wealthtrack.com, to see this program again as a podcast or streaming video. And while you're there, check out WealthTrack Extra, where you can find complete extended interviews with other recent financial thought leaders and great investor guests. Thank you for taking the time to visit with us. Make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.